Welcome. This is Accounting with Bennett Tchaikovsky. Our topic today is going to be non-current liabilities or bonds. Recording interest expense when a bond has been issued at a premium. And we're going to be looking at both annual, semi-annual, straight line amortization of that premium. So let's go back up here to the top. So once a bond has been issued, so take a look at the discount video and I'll kind of skip this front part. We'll go right into the heart of it. What I need to do is I need to amortize this premium essentially down to zero, because when the bond matures, the amount that should be showing up on my balance sheet and the liability should be the face value of the bonds. So here's our first example. If a company issued a bond with a face value of $10 million on January 1st, 2018 and received proceeds of $11 million, assuming the bond's term is 10 years, pays interest annually, and has a stated rate of interest of 8%, what is the journal entry to record interest expense for the year ended December 31st, 2019? And as I'm correcting my own, let's see, wow. So what we want to do first is let's go back to the journal entry that we recorded upon the bond issuance. Notice again, not using the present value tables. I'm giving you these values here to really focus on these journal entries. So the way I'm going to record is I'm going to debit cash, credit bonds payable. Cash is always going to be the cash proceeds I receive. Bonds payable will always be the face value of the bonds. And so right here, the premium on bonds payable will be $1 million. So my goal is I need to ultimately write this premium down to zero. Why? Because when the bond matures, I want this to be zero. So what's going to happen is when I'm recording interest expense, I'm going to credit cash for the amount of cash I'm paying for interest. Here I'm going to be debiting premium on bonds payable. Why? Because I need to make this balance zero. Premium on bonds payable has a credit accounted as a liability account. Ultimately want to make this zero. And so then whatever my plug is or whatever I need to balance will go to interest expense. So here my cash paid for interest, the bond's face value of 10 million times 8% annual interest is $800,000. My amortization of my bond premium is going to be the $1 million of the premium, and this is going to be divided by the number of times interest is being paid. Well, here it's a 10-year bond paying interest annually, so therefore the amount of the amortization will be $100,000. So my journal entry to record interest expense in a premium situation, which will never ever change, by the way, I'm always going to be debiting interest expense. I'm going to be debiting premium on bonds payable, and I will be crediting cash. Since I'm paying $800,000 a year interest in cash, I'm debiting the premium for $100 and debiting interest expense for $700,000. So that's for annual straight line amortization. What about when I have a bond with a semi-annual interest payment? Well, here let's take a look at another example. So if a company issued a bond with a face value of 20 million and received proceeds of 22 million, what's going to be that interest rate in the future? So here I'm receiving cash of 22, crediting bonds payable, which will always be at the face value for 20 million. So my premium on bonds payable here is going to be 2 million. And remember, the premium is the difference between the cash received and the face amount of the bond. And remember, these questions are different than the ones we were looking at earlier because I'm not giving you the present value tables. You don't have to do the market rate. You don't have to do that step. So similar to example one above, our goal is to have this premium on bonds payable ultimately be zero when it matures. So journal entry for interest, Doesn't change. Remember, this is the same thing we've always been doing. Crediting cash, debiting premium on bonds payable, and then debiting interest expense. So the first part here is, what is the cash going to be paid for interest? Well, this bond had a face value of $20 million and a 10% annual interest per year. And that would give me $2 million, but because we're paying every 6 months, I multiply that amount by 6/12. So the amount of cash paid for interest is going to be $1 million. And then in terms of my amortization of my bond premium in this case was $2 million. And the number of times though our interest is being paid, remember this is a 20-year bond. Because it's semi-annual, I'm paying interest twice per year. So my total number of payments is going to be 40 or 20 times 2. And so right here, my amortization of my bond premium is going to be $2 million divided by this 40 or 50,000 per year. Now let's go to the journal entry. So I'm paying out cash for interest, or that 20 million times 10% times 6/12. And I'm debiting my premium on bonds payable right here for 50,000. So to balance my entry, that remaining amount is going to be a debit to interest expense for 950,000. Remember, when we're doing straight line amortization, interest expense is always going to be last. When we're doing effective interest, it's going to be effective interest method, very, very different. So right over here, bond carrying value. So when we have a premium situation and we're trying to figure out the bond carrying value, what we're going to be doing here is with a semi-annual interest payment. Let's take a look at this. So here we've got a semi-annual interest payment, straight line premium amortization. So if a company issued a bond with a face value of 20 million, received proceeds of 22 million, and again, this is kind of similar to the last one we did, what is the balance sheet presentation on June 30th, 2023? Well, again, we saw that this initial entry, and then this was the entry we used to just record our interest expense. Remember, this journal entry, when I'm using straight line amortization, never changes, both the form and the dollar amounts. So here I go to my premium on bonds payable, which had a opening balance credit right here of $2 million. So what's happening every time I'm amortizing this? And this is the time I love to share my pea green soup joke, which is you ask somebody, what did you eat for breakfast? And you say before this, you have to say, whatever I say, I need you to say pea green soup. So what did you eat for breakfast? Pea green soup. What did you eat for lunch? Pea green soup. What did you eat for dinner? Pea green soup. What did you do all night? I pea green soup. Yeah, good stuff, right? But it's a kind of a joke that I want you to remember because this part of it doesn't change. Journal entries here to record the issuance of a bond at a premium, to record interest expense doesn't change. So to go through here and record my premium on bonds payable, I'm going to be amortizing this premium $50,000 every single 6 months, right? It's not going to be changing here. So I'm going to amortize this each 6 months. Okay. And again, I like doing it this way because I know I will always get the correct answer. And so here, when I've got my premium on bonds payable, my ending balance for my premium on bonds payable will be $1,550,000. So my bonds payable was 20 million. My premium on bonds payable is 1,550,000. And my total bonds payable, or my carrying value, is going to be 21,550,000. But what's really happening here? If I looked at my initial bonds payable on January 1st, 2019, what I would be seeing is that I had here a carrying value of $22 million. Why is it less on June 30th, 2023? It's because I want this amount over time to go down to zero, this premium to go down to zero, because when the bond matures, the amount that I want to have on my balance sheet is just going to be $20 million. So that's the way you're going to go through and check your work. Thank you so much for joining my presentation today. Please be sure to like and subscribe, and I will see you at the next accounting video. Thank you so much.